Good evening, guys. So, as I mentioned earlier today, I'm going to post a breakdown of the dollar index. So, the reason why we're using the dollar index is the dollar index is the key to analyzing the direction of bias of the markets. So, as long as you know what the dollar index is doing, that trade you're going to take in Euro USD. So, yeah, as long as you know what the dollar index is doing, that trade you're going to take in Euro USD or Pound USD, it's gonna be profitable or it's gonna be in sync with your buyers as long as you know what the dollar index is doing. So it's easy to know how Euro USD will move or how pound dollar will move after you've done your analysis in the dollar index. So this is the H4 time frame that I'm using. This is H4 time frame, as you can see. So last week the dollar index. So I told you guys to put period separations on your charts. So if you go in an H4 time frame, the period separation you are seeing like from this point to this point. This is the last week's trading price. This is how price moved last week. Where you see in this line, that's where price opened from. It dropped lower, went up, dropped lower again, then went high up. As the dollar index was going up to that level, I'm sure you saw the Euro USD dropping, and I went short in Euro USD, and I was profitable with it. I shared in the group trade that I took in Euro USD where I took some profits last week. So it was because of this move in the dollar index. So as the dollar index was going higher, Euro USD was going lower. So like they are mirror images. If dollar is going high, Euro USD will be going lower. That's a thing. So right now where we are, if we go at last week's high, this point you're seeing here, this is the last week's high, the high that was made last week. So on top of the high that was made last week, there's what we call buy side liquidity. uh, and just to take note, most of the ideas that I'll be portraying in this analysis are the ideas that I got from other mentors and reading books and other sources of information out there. Then I blended them together to have a single way of analysis and how I can view the markets by using different written concepts and actually putting them together to come up with the analysis and all the information that's needed to be in sync with the direction of bias. So buy side liquidity just simply means on top of the high here, there's someone who went short and that put their stop loss there. So in short, on top of the high, there are some orders that are resting there. That's what we call buy side liquidity because it's buying on top there. That's buy side liquidity. Down there, we've got sell side liquidity. That's what we have down. So on top is buy side liquidity, down is sell side liquidity. So if you expect price to go up, it means it's targeting the liquidity resting on the highs. So every time you see a high like this is a high here. On top of this high, there was some orders. There are some stop loss that were put on top of this high. On top of this high, also, there are some stop loss that were set there. So as the dollar index was going higher, it was targeting the stop loss here and the stop loss that were resting on top of this high. So here on these tops and this top, there was some buy side liquidity. So this is what the dollar index was looking for as it was going higher. When it starts to drop down, it will be looking for sell side liquidity. Those are the stop loss that people are putting on the lows. Buy side liquidity, we can take it as the stop loss that people are putting on top of the highs, and price would actually go there to take people out. To go up there to take people out, you are putting the stop loss on top of the highs. As it is coming down, it's coming to take people out who are putting their stop losses on the lows. That's the basic concept. So right now, have highlighted two areas of interest in the dollar index because I'm anticipating the dollar index to go lower this week. So this week I haven't have you checked on your economic calendar? Let me try to check on the economic calendar, just see what's there. I've got issues with network because of the area where I'm staying. Usually the network is bad, especially at night. So let me just try to check on my phone quickly and see if it will give me something because I'm sure it will keep on loading. Yeah. So uh, that's the thing. So these areas that I've highlighted here, I've put IFVG. I got this concept from ICT. So as a yeah, I got that's where I got the concepts from ICT. Then I also read some other books, odds books that I'm going to share in the group. So this week, let me just try to zoom in. So this week the dollar opened at this. This was the this week's opening price. Let me just demarcate it with the green line. So this was this week's opening price in the US dollar index. So the dollar index traded lower, as you can see here. The dollar index traded lower. When it traded lower, it took out this low. What is below the lows? Sell side liquidity. What is above the high? Buy side liquidity. So as the dollar index was dropping lower, it was going the for this low because at this low, whoever went long on the US dollar index, they had put their stop loss below this low. So as the dollar index was coming down, down, down like that, it was targeting the stop losses that were pressed at this low. So as it came down, it took out the stop losses that were resting below here. That's the sell side liquidity. It started going high, high up. So this area have highlighted here as price was coming lower. This level was supposed to act as a support level for price to bounce in this level and continue going up. But unfortunately, when price dropped here, it didn't continue going up. It just went there and made this high. And what's on top of these highs? That's the buy side liquidity. Whoever is going short here, whoever is selling, they are going to put their stop loss on top of that high marked by this red X here. So now the dollar index dropped. This area shaded with this purple demarcation was supposed to act as support to support price going higher, but it's broke through that level. So as price is trading through there, this level can act as resistance. As you see, support broken becomes resistance, or the other way around, if I'm not mistaken. So when price dropped, broke this area, it dropped down and took out sell side liquidity. Then it went up now. So since this level was broken, it can act as resistance for price not to continue higher. So from this level, this is what can happen. So from this level, the dollar index can drop. So if that level act as resistance and the dollar index continue dropping lower, this will mean Euro USD will be going higher, Pound USD will be going higher. That's the narrative. If this area is not taken out, if this area prevents price from trading through and going higher, and the dollar index start going lower here, it means euro will be going higher, USD will be going higher because this level was broken. It was supposed to prevent price from going lower. Once it reached here, it was supposed to go high, but just went high, making this short high, then it broke down. What's on top of the highs? There's liquidity. That's the buy side liquidity. Their orders resting here. The stop losses are pressed there, there. So price dropped lower like that. It came here, this low. What is on this low? Sell side liquidity. It dropped, took out this low. Now it's going higher to go back in that area. Support broken becomes resistance. But what happens usually in the forex market? What I've noticed is this. This is H4 time frame. And if we really want to know what the markets are doing, we have to focus on the body of the candlestick and not the wicks. Because these wicks, these long tails that you're seeing here, these wicks, they differ depending with the broker. So if you want to have a broad view of what the market is doing, you have to focus on the body of the candlestick. So you might find that yes, this area can act as resistance and fail to allow price to go up there. This has to drop lower. But you might find that it can spike through like this. The idea is this. It like can spike through maybe to that level. When it spikes through to that level, that's maybe in the daily time frame. Then it starts to drop lower. Starts to drop lower like this. Can start to drop lower now like that. So now if it spikes through that, you might find that it will start dropping lower like this. But when you go in your daily time frame, you might find that what it will show, this can be a week and the candlestick will close right in this area. You see? So that simply means this area, yes, has acted as a resistance point, but there was that spike of the week as that dropping lower. Or it can just go there. Reason why we are anticipating that the dollar index can destroy this area and go a bit up here is there are some buy side liquidity on this high. So the dollar index goes high there. It takes out this buy side liquidity. Let me just try to zoom in. Yeah. When it takes out this, it will go up to that level. So this level that I'm putting here, it's also acting as a. If you see this big down candlestick here, it moved quickly down there. There was only one side delivery of the market, like the market just sold lower. So to balance up, there can be an upward price. So in short, what I'm saying is in dollar index, we have got two areas on which it can drop. Either this area or that area. So now if it drops here, that's a buy in pound dollar. If it drops here, that's a buy in euro USD. But it can also go up there at the price level. Premium price level. So there are two levels to take, either this or this. But personally, I can be more comfortable when the dollar index goes to that area. I can press my risk if I see trade to that area. Because if it trades to that area, I'll know to say it has taken out buy side liquidity that is resting on top of this high. After taking out that liquidity, I know that it will fill in an area of imbalance whereby there was only downside delivery of price and there was no upward delivery on price, as this candlestick was a big down candlestick. So I prefer it to reach there, take out this high, reach that point. When it reaches this point here, the one I've highlighted in this color, if it reaches that point, I can now go in my Euro USD and Pound USD to look for now buying opportunities. Because I know that once it reaches there and it starts to drop down, that will be buying Euro USD and in Pound USD. So that's are the two narratives. Either it breaks from here lower, or it reaches there, then it continues to go lower. So there are two narratives here. It's either this, the drop here, either a drop here, the drop here, yeah. So either a drop from that level or the drop from this level. So which level are we going to get? So that's where patience comes in. We wait. Let's wait tomorrow, Wednesday trading, and Thursday, and see where the dollar index would like to trade to. So once it trades to those areas, then we can take a trade in these other pairs. So for now, this is the analysis. This is where the sell side liquidity is. That's where the buy side liquidity is resting. If dollar index reaches here, drops, or it drops from here, these are the narratives that we are looking for this week. So for now, we're going to observe the dollar index and see how it's going to behave between these two narratives. So for now, you can actually just go through this video and read through some notes that I'm going to post.